Good morning, everyone. Thank you so much for being here for the webinar, Understanding Cash Flow, being led by Mr. Charlie Ogden. We appreciate you all being here. And just for your information, if you have any questions or comments, the chat will not be working, so please enter them into the Q&A, and Charlie will be answering questions as we go along. I'd like to introduce Charlie. He is the Vice President of Business Banking at First Citizens Bank, and he uses his years in financial industry to help small business owners. So you're in the perfect place. Charlie is extremely knowledgeable, and please feel free to ask questions you have about your business as we go along. So with that, I want to thank you, and Charlie, it's all yours.
Thank you, Michelle. And thanks everybody for being here. As Michelle said, I've been in banking about 10 years on the business and commercial side. So I talk to business owners of all sizes. So I've seen quite a few different things. So hopefully I can give you some tips or some guidance on how to run your business. And like I said, the presentation isn't particularly long, and I'll take breaks along so we can, you can ask questions if anything jumps out, or anything you think of. There are no silly questions or anything, so I'm happy to kind of go through it with you. And if we have time at the end, like so, we can kind of dive into specific questions as well. But we're talking about cash flow today. So cash flow is the life of your business. Whatever business you have, cash flow is the number one thing. So I think this is important. Like I said, hopefully you get something out of it. But a few things we're going to talk about today is what is cash flow, why is it important, ways to manage it, and ways to hopefully improve it. Like I said, it's your business is going to be different than your neighbor's business or anybody else in here, but there are some general tactics we can use to help you hopefully. So what is cash flow? Cash flow is just the movement of funds in and out. It's basically, any way you make money, whether you own an operating business or whether you own real estate or whatever it is, it's you're going to have expenses and you're going to have money coming in and coming out. And that's what cash flow is. But it is the most vital part of your business is getting paid, right? And it's the number one reason that small businesses fail. People either growing too fast or not accounting correctly for certain expenses can relate to businesses failing. So I'm happy that everybody's on here. Hopefully, if you're early in your business, this can give you some ways to maybe avoid some pitfalls along the way going through this. And so I appreciate everybody being on here. I think that's definitely prudent. A few misconceptions about cash flow. You don't need any expertise. Some of the forms we're going to look at today can seem a little bit, complicated or maybe dense, but you don't necessarily have to go through all those. But I think just understanding cash flow on a high level will help you with your business. And then that's why you have partners like your banker and your CPA to help you with a lot of the more intricate details of this. But it's definitely something you don't want to do just annually when you're getting ready to pay taxes or whatever it is. It's something you want to look at daily, your cash flow, especially if you're selling products or if it's something that can change daily. It's something you definitely want to keep an eye on. And it's not just the responsibility of your accountant, it's your responsibility. At the end of the day, it's your business. It's something that they can help you, structure a certain way, but you want to be the one understanding the ins and outs of your business. And finally, your company can be profitable and run out of cash at the same time. We see that quite a bit actually, especially with companies that are ramping up fast, making money fast, as you can unfortunately spend money that you may not have accounted for, and expenses pop up and businesses can go under due to their own success, unfortunately. So like I said, a few things we'll talk through to help hopefully avoid a lot of that. A couple of differences here. Your income statement is also called your profit and loss statement. If you've heard that from a banker or from your CPA, that basically measures the money coming in through sales and then your expenses going out. And then cash flow statement basically shows where all your cash goes as it comes in, goes out, how you're spending it, whether you're investing it, paying your employees and things of that nature. Any questions so far, Michelle? All right, we'll go to the next one. So cash flow statement. So this is basically, like I said, we don't have to get too much in the details unless somebody wants to. But this just shows, it starts with your revenue at the top, that's your earnings, and then kind of goes down through here. It shows how you spent your money, And like I said, this is a little bit different than your income statement, but this is something you should be aware of, and you should, and it depends on your business. Like I said, if you own real estate, you may not have something like this if that's what you do, or if you have a really small business. But as you grow, this is definitely something you want to be aware of, because it shows where all your money's going. You're like, man, all my money is going to where it shouldn't be going. All my sales are going places where they shouldn't be. And this kind of helps you see that from kind of a bird's eye view. Cash flow cycle is, like I said, it's going to be different for every business. If you're in a restaurant, if you own a restaurant or something where you're selling products quickly, your cash flow cycle is going to be a lot shorter from when you buy your products than you sell them, versus if you're in some kind of manufacturing, if you're turning raw materials, that cycle is going to be a lot longer from when you first buy your product to when you actually get paid from your customers. But each stage, you want it to be as short as possible in between those, because you want to get paid as fast as you can. And there's ways to help with that. We'll talk about it a little bit. So here's some tips to shorten that cash flow cycle. And basically, the biggest thing you want to do is keep your money in your bank account as long as you can. So you want to pay out your suppliers as long as they'll allow you. In most cases, sometimes if they give you discounts, like I said, we can go through this on the line, but if it just depends on how you structure your business. But if you can, say, extend out your terms, if you're buying raw materials, if you're buying supplies, and they'll let you pay net 30, net 60, net 90, meaning basically 30, 60, 90 days after you receive them. That's going to help you, because it keeps your money in your account longer to pay your employees or to buy more materials or whatever it is. But a lot of times they'll give you a discount. If you pay, say you've agreed to 30 days, but if you pay in 10, they'll give you a 2% discount. That can be huge if you're in a material heavy business. And obviously, if say you make products and you're noticing one of your products is not selling, it's sitting there longer, it may be time to drop that line of whatever it may be and do the more. There's no reason to hold on to something if it's not selling. Any questions so far?
No, sir.
All right. Like I said, no questions are silly. If y'all anything you want to ask, or if there's anything you want me to expand on, just let me know. So that was ways for you to keep money in your account longer. And then the way you get paid faster, that's obviously the other side of the coin, is you want to pay out as slow as you can, but get paid as fast as you can. So a lot of that's, not getting checks, because if you can avoid getting paid by check for a multitude of reasons, I would. Sometimes you can't, just depending on who your customers are, but checks, most banks and most companies are getting away from that, just because from a timing perspective, somebody can say they mailed you a check, it's lost in the mail, and you got to wait for another one to come if you never got it. But actually, the biggest reason I would avoid checks is fraud, whether you're writing checks out or receiving checks, because that's one of the biggest ways we see fraud is criminals will get checks and they'll wash them and change the pay to and things like that. And it's got all your information on them, especially when you're sending checks out. Obviously, it's got your address, your account number, routing number. I mean, they can do a lot of damage with that. So for multitude of reasons, I would consider getting paid electronically if you can, whether through, like a Square type of credit card or getting paid online. It's just a lot more secure and obviously a lot faster, because you can get paid, right away versus having to wait for a check, or cash obviously works as well. If you're building things, get down payments, just protect yourself. I mean, a lot of this stuff you probably already know, but the worst thing to do is to make a product for somebody and they change their mind or they don't want it. And if at least you've got a down payment, you've kind of secured yourself a little bit there. Software, like I said, a lot of this is going to be as you grow. You may not need this stuff right away, like a QuickBooks and things like that. But the good news is a lot of these have either free or very cheap versions. QuickBooks is a good one to start early. Because it's going to let you generate a lot of these reports, especially, like I said, if you own a restaurant or any sort of operating company. If you're on the real estate side, it's not as necessary early on. You're just really tracking some smaller expenses. But like I said, this is stuff to get early if you can. But it's a lot of the software it may sound great, but you may not need it right away. You can do a lot of this stuff yourself. But there will come a point where it's financially, it's like, all right, what's my time worth right now? Like, all right, I'm gonna hire somebody to do XYZ because I can go out and make more by selling more of whatever your product is. Definitely use a CPA. There's a lot of the stuff you can do on your own, but when you start making money, the CPA is going to be your best friend, because they can really help your tax liability at the end of the year. You'd be blown away by how much how much your money is going to go to Uncle Sam either way, but they can help you. And also let your CPA know what your plans are. Say you start your business this year and next year, you want to do some kind of lending, like you want to buy some equipment, a truck, or a piece of real estate. Let your CPA know that when you're going into it, because they can sometimes change things to where it's more appealing to a bank. Because bankers and CPAs can sometimes be at odds a little bit, because CPAs are trying to reduce your tax liability, where bankers, you need to qualify for a loan, you have to show so much in revenue. And if you cut everything down so far, yeah, you don't pay taxes, but you also may not be able to get a loan the next year. So it's just letting them know what your plans are earlier will help down the road. That way you can kind of say, all right, I got to pay a little bit of taxes, but then I can also get that truck I need to get and get a loan to do it. So that's a good reason to have a CPA you trust. And like I said, work with a bank. I'm sure whatever your bank is with, or whatever your bank that you work with, will typically have a business and commercial banker that you can talk to, depending on kind of what size your business is. You'll see later on, cash is king. I mean, you want to have typically a healthy business. We say 3 to 6 months of operating expenses. So that's to pay all of if you do have a loan already, to pay your employees. You want to have as much cash as you can on hand. It's hard sometimes with the type of business you're in. You may need to buy, constantly having cash in and out, but the more cash you can have on hand, the better. And it helps, especially with trying to get a loan. If we see, all right, me as the banker, if I see, all right, you have healthy cash flow, I can see, keep cash in the account. It's not always just out. It helps us kind of ease the bank's mind to say, all right, if something did happen, if you weren't able to sell so much of this product 1 month, you still have enough cash to cover a loan if we did that. Seasonality down there is very common in a ton of different industries, especially if it's something where you work outside, if you've got like a lawn care business. And that's something that you got to want to know going in, like, all right, I may make a ton of money in the summer, in the fall, but winter, it's going to completely shut down. So you want to make sure you have enough cash, or even an alternate business. I'll see a lot of those guys that men and women that have a, seasonal business that's great in the summer, and then in the wintertime, they switch to something else just to keep the lights on. And lines, like I said, at the very bottom, lines of credit are great for that. If you're in a position to get a line of credit, a lot of times we see where they don't even use it during the summer, but the winter they use it to, keep the business going and work on other projects. Any questions so far?
Not yet.
All right. Like I said, we'll be finished with this in just a couple of minutes, and we can go into any specific, if you have, specific questions about your business, I'd be happy to talk about that. So this is a big one. We kind of talked about this at the beginning, about how you can be profitable, but struggling with cash. And that has to do with basically the way you account for things. If you say, for example, you account for cash immediately, but you don't count for expenses immediately. Say you've got an expense that's a monthly expense, but you don't account for it that way. You can realize 1 month, I already accounted for my cash that month, but didn't account for this expense. And so we see businesses run into that a lot, business owners, where just the way you account for things can often put you in a bad spot from a cash perspective. So just to keep that in mind. Like I said, if anybody on here owns their own business, I could kind of give you an example specifically for that. But generally speaking, it is going to take cash to grow a business, especially if you're just starting out. You'll see, I'm sure if you've talked to a bank, if you're early on in your business, a lot of banks aren't going to lend if you're brand new. So it's going to take your cash, whether that's through your own personal savings or through your home equity. We see a lot of business owners, when they're just getting started, have to go that route. And then you get, 6 months into a year and where you start making money, then it's easier for banks to lend you at that point. But it's going to be hard, most banks aren't going to lend you day one. Unless you've got a ton of industry experience or some other mitigating factors there, but that's typical. But outside of home equity, like there's other ways too with, you see a lot of the crowdsourcing. I lost the word for a second, but there's ways online where you can go in and nowadays, you can crowdsource and raise $50,000 through Kickstarter, all these other companies. And it's a pretty cool way to do it. I mean, they'll take a fee out of that to do it, but it's a way to do that where you're not giving away a piece of your business. And then obviously the other way to get started is through investors. If you have people that are willing to invest in your business, but you're giving away a piece of your business to do that. So just something to think about, that if you're able to do it yourself, I know that's not always the case for a lot of startups, but it's the only way really to do that is with cash. What should you do with excess cash? Definitely, You've obviously got to pay your own personal bills and things like that. But if you can reinvest that in the company, it's just going to make it grow faster. So just a few key takeaways. Obviously, just know how much cash you have. It's simple. And be conservative when you're estimating. Kind of almost think worst case scenario. Like, all right, if I'm next year, I know I'm going to need to buy X, Y, and Z, machines. What if I only sell this much? Can I actually afford that? Like, there's just a few different things. But we always tell people, be as conservative as you can, just for your own benefit. And if you do better than that, that's great. But keep yourself out of trouble to always be as conservative as you can. And we talked about earlier, develop a relationship with your bank, with your banker, and with your CPA. And most bankers, we all know CPA. So if you don't have a CPA yet, talk to your banker, and they'll be able to refer you, and vice versa. CPAs and no bankers as well. And then kind of like what we talked about too, discussing credit options earlier than you need them is great. And I used to tell people, when you first start out, one thing that most startups can get is a business credit card. And I would start there just to start building that business credit. That way, 6 months, a year down the road, you already have some established business credit. And it also helps you from an accounting standpoint. Using your business card for your business expenses versus your personal can muddy the waters a little bit when it comes to tax time. So kind of keeping that separate is best you can. So and finally, cash is king, and understanding all this stuff can help you, operate profitably and grow and do things you need to do. But cash is the big one. You got to have it to do what you need to do. And we're done. So any questions? Like I said, I'm happy to go through specific businesses or specific business questions. I'm not a CPA, so I can't get super in the details on tax related questions, but I can hopefully point you in the right direction.
Charlie, we do have one question. Does your bank work with the SBA?
Yes. Yeah, we are an SBA preferred lender. Most of your larger banks are going to be SBA banks. Usually the ones that don't are going to be very, very small. They'll still work with the SBA, but a lot of times it's going to be a little bit more cumbersome. So any medium to large bank is going to partner with the SBA because they allow us to do loans that we wouldn't do normally because they mitigate a lot of that risk. But yes, and I can answer specific SBA questions too. We do a lot of SBA lending.
Okay, as a startup business, is it possible to get an SBA loan?
It is. It's difficult if you're brand new, and it's really industry specific. So I don't know what industry you're in. Like, so you can come on and talk if you want, and I can answer specific questions. But certain industries are just higher risk nationally, and that's the way that SBA and a lot of national banks look at it. So what can be tough sometimes if say you're in Nashville, and we know that obviously restaurants and all that here are doing well. Restaurants are still considered higher risk because nationally they fail more often than like a doctor's office or a manufacturer. So it can be a little frustrating, I know, talking to banks about that stuff, because like, well, Nashville, we know restaurants are going to do well here, but they just have to look at it on a national scale. So to answer your question, yeah, SBA loans for restaurants are more difficult. But if you're the SBA, I would say what they look at is they're going to look at your personal credit, your personal side. And they're also going to look more at the story than the numbers, because obviously you're not going to have everything. If you're just starting up, everything's going to be a projection, right? And so projections are great, but we don't know. They may turn out that way, it may not. So what they're going to look at is like, say you want to we'll go back to the restaurant. If you want to start a restaurant, or if you want to buy an existing restaurant, they're going to look at you. What restaurant experience do you have? Have you managed a restaurant? Have you owned a restaurant before? If you're somebody like me, like I've waited tables in college, but that's about it. They're going to be like, all right, you've never actually run a restaurant. It wouldn't be a good fit for me. Most places would deny that unless I came in and we're going to put half of it, pay half down or something. But that's the big thing they're going to look at is industry experience. Or say you're buying an existing restaurant. That's great, because even though technically you're new at it, they can look at the history of the restaurant and say, okay, this restaurant's done well, and say you're going to keep one of the managers on that's a key manager. They've got that experience directly. So that kind of thing is what the SBA is going to look at more than just the projections, because it's we don't know how they'll actually turn out.
Thank you. And Dorothy wants to know, how can we know which banks partner with the SBA?
There is a way to look it up. Let me see here. Let me go back to this. I can send you a link. You can go to the SBA website, or you can go to, your bank's website, and it'll say on there, if you go in and look at like business and commercial, it'll say if they work with the SBA. Like I said, I can't think of any now just off the top of my head that don't, but most banks of any size will. I would say if you work with a smaller bank, that may be the only chance that they don't, but they can even refer you. They just may not, they can do an SBA loan. They just may not be, it may be a little bit more of a cumbersome process on the bank side. Either way, I mean, candidly, working with the SBA is a bit of a process because it is a government agency. And anytime you work with that, they ask a lot of questions and they want to know everything. So just be prepared when you do an SBA loan, be prepared that it is a process and it's not something you're going to get turned around tomorrow. Like for example, on conventional commercial lending, I can get, a loan approved within a few days, whereas an SBA loan, it's like 60 days, just because there's a lot of moving parts. And it's, like I said, it's the government, they take their time. So just be prepared on that if you need it. If you think you want to go SBA, if you're your startup, and you need the loan soon, I would start talking sooner than you think with your bank and with them, because there's a lot of information they're going to want you to fill out, a lot of projections and business plans and things. So just know that going in, that it's the same everywhere when you're dealing with the SBA.
Well, what would be the difference between applying for an SBA loan and a commercial bank loan?
So if you're just starting out, you're gonna, I can't say that they will automatically deny you or, turn you down, but most banks are going to want you to have 2 years in business, or 1.5 to 2 years in business, just because without that, they don't have really anything to lean on from a risk perspective. And so if you don't, then that's when the bank is going to bring in the SBA to kind of help mitigate that risk, because that's what they do. The SBA doesn't actually lend any money. They just come in and say, all right, based on the person, the owner, we think this deal will get approved, and the bank, we talk back and forth with them and they kind of come in and mitigate a big chunk of that risk. And then the bank says, all right, we'll do the loan through the SBA. I don't know if I answered your question. I think I went off on a tangent there, but
yeah. So the thing with the SBA, the bank is still making the loan. It's just the SBA is kind of guaranteeing most of that money, correct?
That's correct. Yeah, they'll
Okay.
Depending on if you do a 7A or a 504 loan, those are, and you can, like I said, we can get into the minutia of all that stuff, but yeah, the SBA basically guarantees the risk, but the SBA has to approve it. So like I said, it can
Right.
be just depending on the industry, it can be a bit of a challenge. So that's where you get, and there are also companies, and I can send these out in a follow-up email. There are groups that basically kind of work with the SBA. They're typically nonprofits. And they're community development groups. And so what they'll do is they'll come in, the rates are usually a little bit higher, but they can, there's one that's blanking on the name, but I'll send it out to you guys, to everybody here, but Bridge House Capital is one and there's a few other ones that are good here in town. What they do is they're nonprofits. They typically will come in and help with startups, but they're going to want you to provide some of the financing yourself. So say you need, $200,000 to start a business or buy some equipment, things like that. They're going to want you to come in and bring a big chunk of that yourself. Or, if you have your house, put your house up. If you have, things like that. Like I said, I would just say it's challenging when you're starting up. If you don't have any capital to put in it's going to be hard to get a fully funded loan from anybody. You have to kind of think about, from a risk perspective, that's kind of what banks and even these, the SBA, they're all looking at well, how are you going to repay the loan? So what I tell people a lot of times too, it's like, hey, I need to buy a building to do this business. It's like, well, maybe starting out, maybe there's a way to lease a space, rent a building, lease some equipment starting out until you can really show. It's hard, especially right now, the economic environment we're in. It's not, if you go in to apply for a loan right now and you get turned down, I would say it's probably more an indication of the economic environment we're in and not a reflection on you as a business owner. Because right now, banks, everybody is just kind of tightening up on a lot of things, and they're going back to their core industries and stuff that they would have done, that we would have done, a year or two ago. Right now, it's just with all the kind of the uncertainty. So I would encourage you to say that if you do get turned down for a loan, that it's not just you. Even really good companies right now are getting, they want this huge number, and it's like, all right, maybe we can only do the smaller amount. So Not to disencourage you to not try. I would still try, but I just want you to hopefully know that it's not you. And there's other ways to do it, but it's, right now it's an interesting environment to say the least. But yeah, hopefully that helps a little bit.
We have a couple more questions on this same topic, and I think you've already answered this one. I talked to a banker and they wanted me to show I have the owner contribution before starting the application. Is this normal?
Yeah. So say, I don't know the specific, request that you had with your bank, but like if you're buying a piece of equipment or real estate or whatever it is, they're going to want you to show, all right, if you're, say it's $100,000 and they will only finance 85%, they're going to want you to show that you have that 15,000 to put in. Just like if you're buying a house, you have to show that you have got the down payment. And banks right now specifically are backing off, like we used to do. Like on real estate, we would do 85-90% financing. Well, now that's kind of backed up a little bit. And part of that is because rates are so high. But if you're coming in, it may be like, all right, you got to put down 20% or 25%. So it just depends on what you're buying. Equipment is still, you can do a lot of times buy 100% of that without having to put anything down. But yes, that is very common. And that's, like I said, especially if you're going to a bank and not like an SBA or a secondary lender, they're going to want to see where you have those funds. It's going to be, like I said earlier, it's going to be really hard to come in and get 100% financing on anything right now, just because so many industries are failing or having, tough times, I guess to say. So yes, that is very common.
Yeah, so the lender just wants to be assured that the borrower has a personal commitment in. They've got skin in the game, in other words, their own personal resources.
That's correct.
What's the benefit of an SBA over another type of loan?
That you can get it sooner. And the SBA will do what we call riskier loans that conventional. When I say conventional, that's just a regular commercial bank loan. When you come in, you can either do a commercial bank loan or an SBA loan. But SBA loans like I said, they'll let us do things that we wouldn't normally do. Like if it's a restaurant or something that's earlier on, we may not do, but it's still a profitable business. We say, all right, let's try it with the SBA and mitigate the risk. And they'll let you do longer term sometimes and things like that. The thing to know is the rates are higher with the SBA than a conventional loan. I think they price off of prime. So an SBA loan right now, might be close to 9 or 10%, whereas conventional bank loans are 6%. And SBA loans have a lot of fees and things on them, but they serve a purpose. And what you'll usually typically see is you get an SBA loan to get started, or in year 1 or year 2, you get an SBA loan to get some operating funds, or buy a building, buy some equipment. And then once you hit year 2, 3, or 4, a lot of times we'll refinance those back over to the conventional side, just to get your rate down. And that's typically what we see, or year 5, once you kind of really become profitable. Then you can do conventional bank loans going forward. So the SBA is almost like a bridge. And once you've been in business a while and you are very profitable, you a lot of times won't qualify for an SBA loan because you're overqualified. They really only want to focus on kind of the startup, smaller business, and get you to where you can do bank financing. And it's better for everybody. It's better for you. It's cheaper and less fees and things like that.
Okay. What tools do you suggest small businesses use to better track their cash flow?
I like QuickBooks. It is a good one. And like I said, I think they do still have a free version, or very inexpensive, like several dollars a month version. And it's very user-friendly. You can just go in and put when you get paid. And a lot of times it can link up to like if you use Square or one of the, little card readers, it can link up. So it brings all that in and it can automatically do a lot of that for you. QuickBooks is a great one. And using that, or a lot of times your CPA will have their own software, or they'll have a professional subscription to QuickBooks. And if you're to the point where you're really tracking all that stuff, I would get with a CPA, because like I said, they're going to be able to find things and find ways to track that potentially could save you a lot of money when it comes to tax time. But yeah, like I said, QuickBooks I'd strongly recommend. It's great for everybody.
Great, thank you. Would you recommend crowdsourcing for retail boutiques?
Yeah, I think that's great, especially if have a big social media presence. I mean, I think you can drive a lot of business through crowdsourcing, and then they go to your site and they go to whether you have a pop-up store or, or if it's just online only or whatever it is. But yeah, I think that crowdsourcing is great. It's really helped fill a gap. Like I said, crowdsourcing is even earlier than the SBA, because if you're just getting started, it's going to be even hard for the SBA to help on a lot of those. But if crowdsourcing, like I said, it can be expensive. So just know when you're looking at like Kickstarter and some of the other ones, kind of look at and they'll have all that disclosed on there, how much they're going to take. Because if you raise a significant amount through that, it's usually a percentage. So the more you raise, the more you give to them for sponsoring that, but it's worth it. Usually it's if you need the money, you got to do it one way or the other, and I think that's a good way, especially if you do a lot of online sales and things like that, to kind of spread your name out faster than just, through traditional advertising and things like that. So yeah, I think that Kickstarter and crowdsourcing can be great.
Excellent. I am a startup. I just got my business credit card. What other ways do you recommend to build my business credit?
There's a few different ways. So business credit kind of tracks a little bit differently than personal credit. Business credit will look at outside of just, traditional trade lines, like a business credit card or, a vehicle loan and things like that, is they'll also look at your, what we call your trade lines, like for, say you're a manufacturer or you're somebody that buys a lot of products, and you get on a line, like you can get credit terms with, say, a lumber supplier or whatever, whatever it is for your business. And they can put you on terms and say, all right, it's usually not when you first get started, but sometimes it will be, especially if you have good personal credit. They'll say, all right, you can pay us net 30, meaning you buy the materials, we'll deliver them to you, and 30 days after that it's due. Well, that will actually, most of them will report that to the Business Credit Bureau. So over time, you get enough of those and you don't actually, it'll help, because when we pull your credit, we can see like, oh, he's on terms with so-and-so lumber company and he's been paying them on time and things like that. So even though you don't actually have a loan with them, it's still reported to your business credit. So that's a good way. Outside of that, some banks will let you do like a vehicle. Not a lot of times it won't be actual like equipment, like a big crane or something, but they'll let you buy a business vehicle as long as your personal credit is strong enough. And doing that under your like I said, any sort of credit facilities that you can put under your business credit, even though your personal is still tied to it, that's going to build it faster and faster. So I always tell people, if you have a business vehicle or you have a vehicle you use for business and you have a loan for it under your personal, you can basically refinance that under your business. Your personal, they'll use your personal credit to do it. But what's nice about that is once it's under your business, it actually won't reflect on your personal anymore. So say you buy a car for your business, even though they pull your personal credit to basically do the loan, if you go then a month later and buy a house, then when they pull your credit, they won't see that vehicle. So it won't mess up, kind of drop your, what they call debt to income ratio. Like anybody that's bought a house has seen that. So that monthly payment will no longer reflect on your personal credit. The only time it would show up is if you missed made a payment or defaulted on the loan, then it kind of comes back and hits your personal credit. But it's just a good way for you to not, over encumber your personal credit too. So there's multiple benefits to doing under your business. Usually the insurance might be a little bit higher, but it's usually pretty much the same. So that's kind of the only downside. Sometimes it's a little bit more expensive, but it's a good way to kind of keep everything under your business and not really tie up your personal, especially if you're doing other stuff with your personal credit. You want to kind of keep that as clean as you can.
Thank you. What if you bought an existing business? Do they look at the previous owner's revenue? I'm 1.5 years in business, but overall 17 years.
Yeah, so that kind of deal is a little bit different than if you're just starting a business scratch. We actually can do more business loans, or I guess you can say you have a higher chance of getting approved if you're buying an existing business, because there's not based off of projections anymore. You can look at, and you should, if you're buying a business, you should look at the historical financials and say, all right, how profitable were you? How were you doing and all this? And the seller will understand that. They're not just going to expect you to buy a business without looking at the financials. But yes, you can get an SBA loan much more. You have a much better chance of getting a loan to buy a business. Or if you've already bought the business, like you said, you've been 1.5 years in, you bought it, that it's not a startup at that point. The business has been around. You're a new owner, within a couple of years, but the business itself is a seasoned business. You've got, years of financials you can go back and look at. So yes, you could even potentially get a conventional bank loan on that, looking at, since we'll have years of, that's like I said, banks are historical lenders. So we'll look at, whether it's you owned it or somebody else, the business has been around. So there's historical financials to look at. So yes, to answer your question, you could get an SBA loan or even a conventional loan at that point.
Thank you. Any materials, books, or others that you recommend to learn more about cash flow?
Yeah, that's a good one. I'll send over a few. You put me on the spot, but I'll send over a few good resources. There are. And what's cool nowadays, I mean, YouTube is good. I mean, there's so many free resources now. You can go on there, or I don't really do much with TikTok, but I mean, there's so many free ways to learn cash flow and things like that, yeah, absolutely. I'll send you a few ones that I know are trustworthy. But that's a good question. Yeah. Happy to send those over.
Very good. Thank you. Do I need a small business certificate to be eligible for an SBA loan?
I'm not sure what a small business certificate is. Can you elaborate on what that is?
Ty, can you elaborate? You can unmute.
You may still be muted. Oh,
hang on. Here it goes. Okay.
Hey, can you hear me?
Yes.
Yeah.
It's just something I've heard before that, so sometimes, you can get some government contracts if you got the certificate, small business certificate or license. And I was just wondering if it works in the banking too, that you need that certificate to be able to get a loan, that SBA loan that you were talking about.
I don't know. I mean, I know that there's a lot of different, certifications and things that businesses can get. I'm not familiar with specifically what that one is. I'd caution you a little bit on that. There's a lot of companies out there that will give you certifications and things, but they don't actually mean anything. And you can send me, if you want to send a link over of what you're talking about, I can tell you whether it's legit or not. But really, certifications can help you get certain kinds of contracts and things. Like if you're like a women-owned business or a minority or veteran-owned businesses, those can help you with certain types of grants and things like that. But banks are really going to be looking at your cash flow, like how have you performed. Certain kinds of certifications and things like that don't typically, they can help, I would say, if depending on kind of what you want to do, but how the business is performed is really the most important thing for getting a loan.
Right.
Yeah.
Okay, thank you. The small business, I think certificate is the same one that you're talking about, similar to woman-owned business or minority-owned business. And there's a certificate from the government just for that.
Okay. Yeah, just like I said, anything where you have to pay for it, just read through it and make sure that it is legitimate. And because a lot of times there's just, I said that one probably is, but there are a lot of certifications that people make you pay for and go through, and they actually don't really do much. It might be something where if you want to join, I know like certain trade groups and things will require you to have some kind of certifications, or like Angie's List or something like that to be a preferred business. They may want you to go through some kind of background. But yeah, a lot of that stuff it's really, to get a loan, it's really going to be a cash flow.
Right. Thank you.
Sure.
Okay, next, what is your take on the health and wellness industry? Detoxing, clean eating, etc.
Yeah, I mean, I think that personally, my family and we are very pro, organic, eating clean and all that. But I think that the market, if you're in Nashville or if you're in like Brentwood or Franklin, I mean, I think you're going to crush it, because there's a lot of affluent folks out there that will pay for stuff like that. But yeah, I think it's great. I mean, I think depending on what you're doing, there's a lot of people in certain fields of that industry that you don't want to be like one out of a million or one in a million of doing the same thing. But yeah, I think it's a great industry. I think more and more people across the country are kind of realizing the importance of all that. So it's shifting towards that. But the only thing I would say is anything, especially right now, if we're heading into a further recession, I would say anything that is a luxury, just realize that those are typically the first things to kind of struggle. If we have a true like deep recession, which I don't know if we will or not, but those things like, like pet spas and, anything that's interior design, anything that's like a really considered a luxury, those can be things that struggle because people kind of hold on to their cash and spend them on more than necessities. So not to say that will happen, but just something to think about. And that's kind of how banks look at it too. We kind of look historically at things that fall during recessions. And a lot of it is those kind of extra, luxury industries.
Okay, and our last question, do nonprofits also qualify for the loans?
Yeah. I mean, our bank, most banks do nonprofit loans. We do as well. They're underwritten a little bit differently, but like we do a lot of, church loans and things like that. And we just look at them a little differently. We look at, how the giving happens. I would say if you're doing a nonprofit, if you're starting a nonprofit, or if you have an existing nonprofit, one thing that banks and the SBA will look at is any sort of concentration. Like if you have one large donor and that does 80% of your giving every year, it's going to be harder to get a loan, just candidly, because the question is going to be, well, what if that person stops giving, or what if they do something else, or, whatever happens. But if you have a good mix of, you don't have anybody giving more than 20% or 30%, then that would be helpful for getting a loan. So that's just something to think about. And you can't control that, obviously, but just know that it will be harder to get a loan if you have one person. Now, if they set up some sort of trust or agreement where you're going to get that every year for the next 15 years, then that's different. But concentrations can be the only thing that hurt nonprofit lending.
Okay, we have one more question that came in. Are food trucks treated differently with small loans compared to small restaurants?
No, the only difference is you would be getting a shorter term, potentially. So on real estate, most of the time we can go up to 25 years on your term, and that's how how far you spread out your payments. So you can get just your monthly payment. So if you're buying a $500,000 piece of real estate and you spread out those payments over 25 years, your monthly payment's a lot lower versus if you're buying a $100,000 food truck and outfitting and everything. Most of the time you're going to be able to go 6 or 7 years because the collateral, being the vehicle, loses value much more quickly than real estate. Real estate kind of actually goes the other way, it goes up. But just know that even though your loan should be a lot smaller, your monthly payments might actually be close to the same as a big piece of real estate because that term is compressed. But no, we would just be an equipment loan. We and most other medium to large banks have a whole division that handles that stuff, so they can pull the VIN number of the vehicle and kind of estimate the value and do all kinds of kind of catered stuff just specifically to food trucks and any sort of vehicles or equipment in general. But that would be the only difference. It would be treated as an equipment loan versus a real estate loan.
Very good. Thank you, Charlie. Any closing comments you want to make?
No, I think the only thing, like I said, is it is a tough environment right now. So I would just encourage you that if you do get turned down, know that it's not just you. And if you are able to maybe kind of ride out right now what's going on and not just manage your cash flow without necessarily, if you absolutely need a loan, then get it. And if you're able to qualify for one, but if you don't qualify, I would say that it's going to get better. And it's just know that it's likely it's not you. It's just kind of what everybody's going through right now. So I would just encourage you to keep doing what you're doing and keep trying, and you'll be able to get one. Hopefully we'll kind of ride this thing out soon and everything will go back to normal. But that's it. But thank you all, everybody, for letting me talk. And like I said, if you have any questions later on, we'll share my contact information. I'll be happy to talk to you and point you in the right direction.
Very good. Charlie, thank you again. And thank you all for being here. We will be sending out information to you within the next 48 hours, including that information and the websites that Charlie was talking about. So without any further ado, please watch your emails for additional workshops that SCORE Nashville is offering, and we wish you much success. Have a great day, everyone. Thanks again, Charlie.
Thanks, y'all.